On the Express this week, stocks defy the September swoon, but things are getting pricey out there. Do old valuation metrics even apply anymore? Our buddy Kenny Polcari drops in for a family style throwdown in just a few minutes, the Investopedia indicator, and what to watch this week. Microphone check 1 2. What is this? The Investopedia Express, all up in your business. Welcome back and welcome aboard. Happy Monday to all of you. We're winding down here to the final couple of trading days in the third quarter. Stocks rising on a Monday morning after kind of a rough, pretty jumpy last week. Stocks ending the week higher, but we are a little bit higher as we start out the week. Again, 2 more trading days to go in the third quarter, and we're going to finish up September in the green. Not very traditional. September, one of the weakest months of the year for the stock market historically. There were walls of worry everywhere throughout the past month, but stocks just churned higher. And it wasn't just the Magnificent Seven powering stocks to higher highs. We had a couple of record highs last month and probably a few more on the way because they do come in bunches. All those worries, all those concerns about tariffs, all those concerns about a slowing labor market, what the Fed might do, what might not do, yet investors still pushing equity markets higher and just about 1 or 2% off of all-time highs right now. Looking in headlines right now as we start a Monday morning, EA, Electronic Arts, the big video game company, going private in a $55 billion deal. That's the biggest leverage buyout in history. Shout out to our guys at Barbarians at the Gate, one of the great books about leverage buyouts. This is a big deal, and this is just another example of a massive public company going private. Who wants to be public anymore? Shout out to you, Bawa Yaga. Thank you for joining the Investopedia Express. Shout out to all of our viewers and our listeners from around the world. Bawa wants real analysis on inflation and economy in an overview. We got that on Investopedia.com. But back to what's happening in the markets today. Again, a big leverage buyout here, $55 billion. Electronic Arts off the table, going to be a private company being bought by the Saudi private investment fund Silver Lake, which just got the rights to buy TikTok. Thank you very much. And another company, Affinity Private Holdings here. So that's what's happening right now. And as we look at the scores on the doors so far this year, about 3/4 in the books, look what's leading the market. Gold up 41%, global stocks up 24%, Bitcoin up 17% this year. Stock market itself up 12 to 13%, the S&P 500. High yield bonds having a nice year, up 10%. The dollar down 9%, and oil down 10%. That may explain what that strength is in global markets around the world. But no matter how you look at the stock market right now, when you look at traditional valuation metrics, it's overvaluation nation. Everything's looking expensive. Great debate going on within the stock market among investors. Is the stock market overvalued? Are we looking at the right things, right? We got 3 flavors of overvaluation. We're going to bring them here to you right now. Forward price to earnings ratio that measures earnings going out 12 months, and that's at 22 times. And that's usually how that's as high as it's been in many, many years, maybe as high as it's been since 2021, but definitely since the dot-com bubble burst. The trailing price to earnings ratio that looks back at the past 12 months of earnings, that's at 28 times, also very expensive. And then the cyclically adjusted price to earnings ratio, the CAPE, they call it, made famous by Robert Shiller, the Nobel Prize winner from Yale University. That's at 40 times. That's the highest since the dot-com bubble. But the other side of the equation is, on the other hand, maybe we're looking at metrics that don't really apply anymore when we think about the companies that are driving the stock market higher and that are driving our economy higher. And there's a lot of ways to look at this. If you look at price to sales ratio, this chart here coming up from our friends at Bespoke, that's at an all-time high, 3.33, right? Price to sales ratio, and historically at an all-time high. But when you look at the equal weight S&P 500 price to sales ratio, that's kind of in a 12-year range here. And that's flattening out all the stocks by market cap. That doesn't give you NVIDIA at $4 trillion and Microsoft at $4 trillion. This flattens all the stocks out so they're equal weight. That actually looks pretty normal, 12 times within the 12-year trading range of the equal weight. So the entire stock market, if you just weight it out equally, looks pretty fairly priced. It's the biggest stocks in the market that are making it seem more expensive. And that's just valuation going to the biggest stocks in the market that are churning out the highest profits and the biggest sales. Smart chart here from our buddies at Carson Research. Sonas Varghese put this out last week. Is it irrational exuberance, as Fed Chair Powell kind of hinted at the other day? And we heard Alan Greenspan say that back in 1996? Or is it just that these companies are just so much more profitable than they used to be? Profit growth has been driving the stock market returns since 2019, along with some favorable interest rates. But when you got companies churning out profits like the NVIDIAs, the Palantirs, the Microsofts, the Apples of the world, you're going to get higher valuations. And that's just the way things are. And that's maybe just the new way to evaluate markets these days, just because we have this revolution going on. And these companies aren't churning out profit growth looking at 1 year at a time. They are building $100 trillion AI infrastructure that's going to take 5 to 10 years to complete, which is why some investors are like, forget the old valuation metrics. This is what's going on right now. So let's get into this with our good friend, Kenny Polcari. He's a partner and the chief strategist at SlateStone Wealth. He's going to drop in for a couple of good minutes. Kenny, so good to see you. It's been a minute since you've been back on the Express. It's always good to see your face, and I follow you every single day. Thanks so much for being with us.
Thank you.
I want to make sure we can hear you okay, but it's been a year full of surprises, Kenny. Give me a microphone check 1 2.
1, 2, 3, 4, 5.
Oh, you're sounding good there. All right. Full of surprises, as we've been talking about. Stock market's kind of defied all these concerns about tariffs, as I just mentioned, a slowing economy, slowing profit growth, potentially a weak labor market. There's been almost no volatility. It's been the quietest year ever, despite all the noise in the economy. International stocks are crushing the U.S. right now. Gold continuing to make record highs, and everyone, including individual investors, are turning bullish all of a sudden. What, if any of this, surprises you, Kenny?
Well, I think what surprises me the most is that we went from being so negative in April when we had that Liberation Day and everyone was panicking and, oh my God, the world's coming to an end, and they sold everything. They couldn't sell it fast enough. And then suddenly, as people thought about it, and there was some more conversations about tariffs, people started to take it in stride. Next thing you know, they've taken the market once again to brand new highs, all-time highs in 2025, and probably we're going to make another one before the end of tomorrow, which is the end of the third quarter, right? And so I think that's what's really surprising is that we haven't. It's fine that the market rallied back. It's fine that people calm down over the tariffs, but what it continues to do is continues to surprise to the upside. There's been no breathing. There's been no opportunity for stocks to digest the move. And while I agree with you, I'm bullish on America. I'm bullish on tech. I'm bullish on all that stuff. But I'd like to see the market digest a little bit, which it hasn't done. Every time it tries to pull back and we drop 1% or 2%, and suddenly everyone comes in to buy it. And I think some of that may be because asset managers were so worried about the tariff thing and investors were so worried that they weren't sure. They kept a lot of money on the sideline. And now that they see the market's making new high after new high after new high, and it's not coming in, and we're talking about tech, we're talking about it changing the world. So every time it backs off a little bit, they jump in. And so we may see this momentum continue, right? Which I think just concerns me a little bit in terms of people getting, too bullish or that fear of missing out trade. Look, as a wealth manager, we're fully invested, right? So I'm not in and out of the market. We're fully invested, but that doesn't mean necessarily that we're chasing. We're in tech. We love tech. We own tech. We've owned it. But up here, I'm not chasing it. We're not chasing it. We're going to let it kind of digest. There are other places, to your point, to be able to put money in the market. And the S&P equal weight points that out. If you look at the difference between what the S&P is, what the equal weight is doing, that points it out. So other parts of the market are, in fact, underperforming where there is opportunity. Energy, healthcare, basic materials, consumer staples, boring for sure, but they are sectors that have underperformed the broader market, and in my view, present an opportunity.
Yeah, we just showed that chart of the equal weight price to sales ratio. It's relatively normal because these companies are relatively normal and they're not churning out profit growth at 50% or revenue growth at 50 to 100% like the NVIDIAs of the world. They're just doing business as usual, and earnings have been pretty solid, Kenny. So
Right.
you were a floor trader for years, and you've been earning money and investing as a market strategist for years and years and years. So take us inside the mind of a portfolio manager right now. 2 days to go before the end of the quarter, 2 trading days to go before the end of the quarter. Everyone, as you say, was kind of bearish coming into this year until maybe April 9th. And then all of a sudden, everybody's bullish again. Talk to us about window dressing and what that means to the market in general.
Well, I also think as we came into, late summer, August into September, tends to be, September, October time period tends to be historically a weak, kind of volatile time of year. And no one had any reason to suspect that this year it was going to be any different. But when September never backed off, when it never happened, again, all these people that maybe were waiting for an opportunity, and then all this cash are now realizing the end of the third quarter is coming, and they want to look like they've been in it all along. So you have this window dressing, which means that a lot of these asset managers, they get rid of the losers and they want to pile into the winners, so that when they send the report card out, in a week and a half, and investors look at how their portfolios are doing, they're going to see, oh, just look, we own Palantir, we own Nvidia, we own AMD. Whether they've owned them for the whole quarter or not is not the issue. All they're going to know is that right now those names are in there, so that's a good thing. And I think that's also what's been pushing the market up into the last couple of days of the third quarter. It has been that window dressing, asset managers and even retail investors trying to play catch up, right? But I think, come Wednesday, which is October 1st, it kind of wipes the slate clean, right? We're now in the beginning of the fourth quarter, and you've got 3 months for the market to react. And so you've got earnings season just 2 weeks away. You've got lots of more eco data. You get the ongoing conversation about the Fed. You got Beth Hammock that came out. She said it last week, but she reiterated it again overnight on Squawk Box Europe that, the Fed's in a very antsy place about trying to balance a supposedly weakening labor market along with a very strong economic data market, right? And so I actually think you might get that the narrative about maybe we shouldn't cut so fast. Yes, we can still stay on a cutting cycle, but instead of 2 more rate cuts this year, maybe we only get 1.
Yeah. Does that matter as much anymore, or have investors look way beyond that? They look beyond tariffs. They look beyond whether we're getting 1 or 2 cuts. They know we're going to have a dovish Fed for the next few years and beyond. What do they care about?
Well, we hope the Fed is going to be dovish, because if the data continues to remain strong, how much more dovish can the Fed get, right? The Fed would get dovish if it really thought it were trying to solve a problem. But if the economy remains strong, if unemployment doesn't soften, then my point is, then rates may be actually at the right place at 4.25. Maybe they go to 3.75, 4. But much beyond that, unless something really starts to break, I'm not sure that we should see them go lower, because all that will do is stimulate the economy. And I get it. There are small businesses that would love lower rates, and certainly the home builders want lower rates because they want mortgage rates to go down and all that stuff. But if it doesn't make sense, it doesn't make sense. Look what they did in 1978, 79. And I don't want to go back that far, but you have to look at history. When the Fed prematurely cut rates because they thought they had slayed the inflation monster, and in fact, by cutting rates, all they did was stir up inflation. And remember, inflation surged, causing Paul Volcker at the time to have to force rates to 21% and bring the economy to a screeching halt over 2 years. I'm not suggesting I want to see that happen, but I think I think Jay Powell is right, and I think other members are right. You have to be very cautious. We had 15 years of zero interest rates, which wasn't normal either. So there's this normalization process, and I think you have to be very, very methodical on how they cut. So I'm in the camp that if we get 1 more rate cut this year, that's actually okay.
Yeah, and rates are actually not that high right now, and neither is inflation. When you think about historical standards, people get crazy about it. Go back to the 70s and the early 80s. It was no fun.
100%. Listen, historically, between 4 and 6%, that's really historically normal over the long period. Sure, there were times in the late 70s where rates were 20%. Not that wasn't normal. And then for the last 15 years, from 2008 till 15 years, 2023, rates were basically at 0. That wasn't normal either. There's a whole generation of people that think 0 is normal. 0 is not normal. It's not normal. So these people that want 2% mortgage rates, guess what? That's not normal, right?
Speaking of not normal, Speaking of not normal, Kenny, let's look at some of the top performers in the stock market so far this year, 3 quarters in almost. And there's some surprise names on that. And there some of these names make perfect sense to me. We got
Yep.
Robinhood Markets at the top there. That stock's up 226%. But you also got some chip makers in there, and chip makers have been, the chip makers are building the railroads for the next 10 years or so.
Right.
But there's a couple of surprises and a couple of companies out there where you say, what, besides Warner Brothers, which might be going through a breakup, and GE Vernova, which was split off, there's some other
Right.
companies in there that investors have just been flocking to. It's not been the Mag 7 this year, as everybody thinks it is. It's been a lot of these other companies busting out.
What's interesting is I look at that list. Names like Seagate Technology and Western Digital that were big names earlier in this decade, in this century, kind of got quiet, right? Like you don't. No one's talking about Seagate, Western Digital every day like they're talking about Apple and Google and Palantir and Nvidia. Suddenly, though, if you look, you see the massive outperformance that Seagate and Western Digital have this year. I mean, look at them up triple digits, 150%, 130%. But to your point, they're right, because that's part of the infrastructure. And people, and investors that bought into that are certainly benefiting as well, right? Robinhood, though, I get Robinhood. I mean, I'm not sure why it's up 200%. I get what they're doing and all that stuff. I'm not a Robinhood owner. I never was. I certainly understand it, but I'm not sure that I see why it's up 200%. That's a little bit off to me. I would not have assumed
Risk on. I think that's the ultimate example of a risk on
yeah,
trade if there ever was one.
completely. And maybe it's because, they reach out to all these people and make investing, quote unquote, across the spectrum so easy that, there's your reason. But I was never a Robinhood owner. So, I can't speak to owning it.
It just tells you how hard it is to actually pick stocks in this environment, because
Right.
none of very few people had that top 10 on their bingo card this year. I would venture to say nobody did. Sometimes just easier to buy the index, the ETF, or go sector rotation to sector rotation. All right, give us your key fundamental, your key things that you're watching this year. I want a fundamental metric and maybe a technical analysis metric. Two things that you're really focused on. If it's not going to be rates, if it's not going to be the labor market, what are you watching as a strategist?
So I continue to watch the strength of the data, the strength of the economic data, not even so much the labor market data, but the broader economic data, the PMIs. Look, the United States is a 75% services economy, not a manufacturing economy. So things that are important to me are things that speak to the service part of the economy. And if you look at the services PMIs, that has been and remains in expansionary territory, right? We didn't see that ever go into contractionary territory. Manufacturing did a tiny bit. Now manufacturing is actually right on the cusp, probably going to tickle into expansionary territory this month. We're going to get it tomorrow. We're going to get it this week, both manufacturing and services PMIs. And I also want to pay attention to, average hourly earnings and personal consumption and personal spending, because those speak right to the health of the consumer. And guess what? Those numbers have been relatively strong. You do not see the consumer throwing in the towel, say, I can't do it anymore, right? The last two readings of personal consumption and retail sales were much better than expected. That tells you that the consumer, at least by the data, tells you that consumer is feeling okay, which then argues once again to, does the Fed need to stimulate it any further? And so that takes us right back in that circular conversation, right? I don't think they do necessarily. Maybe one more cut, maybe two max, but are we going down another 125 basis points? I don't think so. I don't think we should at the moment.
Yeah, no time soon. So yeah, we continue to spend. Retail sales remain relatively strong. Earnings are still decent, right? We're still outpacing inflation. We feel
Yeah,
terrible if you look at consumer sentiment, but we're still spending. And as
yeah.
long as we're spending, that's 70% of GDP.
Right, but that's where the divergence is. You say you don't feel good, right, in consumer confidence, yet every time the spending numbers come out, you're spending like there's no tomorrow. So which one are you really paying attention to? In my mind, I'm going to pay attention to what consumers are actually doing versus what they're saying, because you never know who they're really canvassing when they call the poll and they say, how do you feel today, versus, so you get one set of data, and then when you get the actual spending numbers, you see it's a very different data point.
Yeah, to my point, are we even measuring the right things, and who are we even asking when we're measuring these things? All right, what could stop the relentless bid here? You mentioned spending, you mentioned the health of the consumer. We know that's a very big deal. We're a services economy. How do things fall apart if they fall apart, Ken?
Well, so where I think it's going to fall apart is if, in fact, they reignite inflation. And right now, it doesn't seem like it is. It's kind of stirring there around 3%, which, by the way, I think 3% is the new 2%. Look, we talked about it before when inflation was up in the 5 and 6%. They kept asking the question: Are they going to raise the target? I think they have subconsciously raised the target. I think they're comfortable with 3%. I don't think I think they realize they're not going to get to 2%. It's going to be very difficult to get to 2%. So the Fed is happy with 3%. But if you start to see it tick up from there, if you start to see unemployment, they keep saying the labor market's softening, yet unemployment's at 4.3%, which is at historically low levels. It's basically full employment at 4.2%, 4.3%, which is what it's expected to be this Friday. So I don't see that nervousness yet. If you start to see that number tick up, and my fear is if it starts to tick up and it ticks up quickly, that's certainly going to be a killer, right?
Yeah, we're watching that pretty closely as well. All right. We're not letting you out of here without getting a fall recipe for my guy, Kenny Polcari here, one of the great home chefs. There he is right there in the
Oh my
kitchen.
God.
Your favorite place. Look at you right there. Looking great, by the way. Give us a fall recipe, and I want a wine pairing to go with it. And folks, if you're not following Kenny, you must follow him. If you don't love the analysis, stay for the recipes, stay for the wine pairings. Such good stuff there, Kenny. Give us something for the fall.
So listen, it's fall, right? So we're coming into Thanksgiving, coming into the pumpkin season, all that stuff. I love this dish. It's just a pumpkin risotto. So it's delicious. It's not difficult to make it all, but you got to make sure that you're using pumpkin puree and not pumpkin pie filling, because there's a difference. It won't come out the same. So, you need the shallots, you need the rice, you need the white wine, you need pumpkin puree, you need a fresh grated Parmigiano cheese, you need chicken stock. Right? And you need a little bit of salt and pepper, very little salt though, because the cheese is salty. And so make it like you would make a regular risotto, right? Start with the butter, melt the butter, do the shallots, brown the shallots in there, then put the rice in, toast the rice. In this case, you want it, if you can get it, you really want to use carnaroli rice, which is a particular type of rice from a particular region of Italy. It works better for this. And toast the rice in the butter and the shallots. And then once it is, you start to add in the ladle of chicken stock, one ladle at a time. Add 1 ladle of chicken stock, let it absorb. Then add the white wine, stir it around, and let that absorb. And then you're going to add 1 more ladle of chicken stock. Once it absorbs, you're going to add the pumpkin, stir it in, mix it up, and then you're going to keep adding the chicken stock as you would a risotto. You add it, you let it absorb, you taste it till you get it just about right. Should take you 20, 25 minutes. When it's
Am I just stirring constantly? Because
you
risotto, you got
have
to
to
keep
stir it. Yeah, you have to stir it constantly. You can't just let
get
it sit
comfortable
there.
at the stove.
Yeah, you have to stand at the stove and stir it. Make sure you get good Italian music playing while you're doing it. In any event, once it's ready, you take it off the stove. You add a dollop of butter. Then you add the fresh grated cheese. You taste it, adjust it for a little bit. Maybe it needs a little bit of salt, and adjust it a little bit. And then with this, and then serve it, in a nice warm bowl. And then if you want to pair this would be something light, right? So you don't want to, if you're going to drink red, you don't want it to be a heavy red, like a Brunello di Montalcino. You don't want that. You want something like a Pinot Noir, or you can go with a white, right? If you go with a white, don't go with anything fruity. Go with something dry, like a Pinot Grigio Santa Margherita.
Yeah, that sounds amazing. I don't know. I went right to white in my mind, but beautiful.
You can
recipe,
go either way.
for the fall.
If you go with a light red, you're good with it.
Yep. All right. We love that. Perfect for the fall. Great recipe. Great analysis as usual. Folks, follow Kenny Polcari on Twitter, on LinkedIn, on all the platforms there. He shares his analysis every day, bright and early, because no one gets up earlier than Kenny Polcari, and his recipes. A good friend of Investopedia. Thanks so much for joining the Express, my friend.
Thanks for having me.
Oh, so good to talk to Kenny Polcari and get his smarts and that terrific recipe. We'll make sure we link to it in the show notes. And let's get to a little money in motion. So we've been talking about gold prices, gold hitting yet another record high, up about 46, 47% this year. It's the ultimate inflation hedge. We know central banks have been storing it. Individual investors have been buying it. I've heard strategists on Wall Street telling us to ramp up your allocations up to 20, 25%. And gold has been on the move. But silver, one of the other precious metals out there, and one I have a particular affinity for, doing pretty good on its own. And silver is nearing record highs as well. It's up 24% year to date. The spot price around $46 per ounce there. And why is that happening? A lot of the same reasons that you're seeing this rally in gold, but silver has more industrial applications, are a little bit more widely used because it's cheaper, a lot of industrial demand. It's an inflation hedge. Central banks and big investors have been stockpiling it. The weakening dollar and lower interest rates, that just props up the metals like gold, like silver, like palladium. And that's why we're seeing silver nearing record highs as well. What's the outlook for silver compared to gold for the upcoming months? I think both of them are trending higher because we got concerns about inflation rising again. We got the dollar continuing to slide. We got all types of worries about tariffs and everything else that's happening or not happening in our economy right now. And you've just seen this relentless surge in metal. So I think gold and silver kind of trading in tandem, although you see gold outperforming silver by about 20% right now or so. By about 50%, I should say, right now. But silver is still something to watch. And some of the silver stocks have been gushing since this rally began. So look at the silver stocks and silver ETFs if you want to look at the direction of the market. Good question there. All right, we got a busy week coming our way. So let's get into what to expect this week. Well, first and foremost is the possibility and the real possibility of a government shutdown. If Congress does not agree to these short-term funding resolutions, we might very well get a government shutdown as of Tuesday night, which is kind of a pain and unnecessary and doesn't really affect the stock market, but something we're going to watch pretty closely. We do get pending home sales today on Monday. We got Fed speakers on tour all week long. Fed speakers are talking left, right, center. Everyone's talking right now about whether we should lower, whether we should raise. You heard Kenny talking about it earlier. Some earnings coming out this starting today with Carnival Cruise Lines and Jefferies Bank to start things off Tuesday. Job openings and labor market turnover survey. The JOLTS report, one of my favorite reports of the year, because we get a pretty good idea of how many people are quitting their jobs and how many jobs are out there and available. Consumer confidence for September, that number rolls in. The Case-Shiller home price index, we know home prices starting to level off a little bit, and earnings from Nike on Tuesday just do it. And on Wednesday, the labor market data continues if the government isn't shut down with the ADP employment report, construction spending for August, S&P final U.S. manufacturing and PMIs, of course. And on Thursday, initial jobless claims, factory orders for August, how were factories impacted by tariffs, and we'll get deliveries from the automakers, especially Tesla. Everyone's got their eyes on Tesla's deliveries, see if that business has recovered. And then it all leads to the big jobs report on Friday for the month of September. We're still looking at tepid job gains. Month after month, we've only averaged 29,000 for the past 3 months. Question is, does the unemployment rate hold at 4.3% or does it shoot higher? But the big question around all of this is, do we get data at all this week if the government shuts down? One of the first places that will stop collecting and issuing data and issuing releases is the Bureau of Labor Statistics, which means maybe we don't get the jobs report on Friday. Maybe we don't get the inflation report in another couple of weeks. So that's one impact of a government shutdown, not to mention a lot of supply chain disruptions throughout government, maybe people not getting their medications, people not able to enroll for Social Security. It gets pretty messy out there, and hopefully this is resolved before the end of the week. They usually are, but still, that could be a mess. All right, the indicator of the week. What am I keeping an eye on this week? Well, as we talked about with Kenny and at the top of the show, individual investors are suddenly as bullish as they've been all year. Where you been? Right? We were looking at the AAII sentiment survey for the past week. There's more bulls and bears now. First time all year, there's more bulls than bears as far as individual investors go. And we, Investopedia, have our sentiment survey in the field. We're going to be debuting that tomorrow night on CNBC. Every 2 months, we survey the smartest readers in the world to see how you're feeling, bullish, bearish, fearful, greedy, and the AII sentiment survey is a pretty good tip-off indicator for that. So why are we so bullish these days? That's something I am keeping a very close eye on as stocks dance near record highs. And two other bonus things that I'm keeping an eye on this week. Last week, maybe you didn't hear about it, but FINRA, which is basically an industry consortium, financial industry for the financial industry, just relax rules on pattern day trading. It used to be that you used to have $25,000 in your account if you were going to day trade, make more than 4 trades a day. Well, they're relaxing that rule. So now you're not going to necessarily need to have $25,000 in your account to day trade. That's going to encourage a lot of risk. And folks, if you're thinking about trading for the first time, if you're thinking about jumping into this market headlong as we dance near record highs, and all of a sudden there is no limit on how much you need to have in your account to pattern day trade, I suggest you and I urge you strongly to learn how to day trade, to learn technical analysis, to learn risk management, because about 95% of day traders lose money. And if you don't know what you're doing, and if you don't have rules, you are going to lose money as well. So this is very interesting. Relaxation of the rules by FINRA. And one other thing that caught my eye over the weekend, smart article by the Wall Street Journal about hedge fund managers becoming so big that they need their own agents. Yeah, they're having their own agents, just like athletes, just like entertainers. They're making so much now that they need to have agents who negotiate their deals, who plan their activities. This, my friends, if anything, could signal a top in the market. When hedge fund managers need agents, anything goes right now, and no rules on pattern day trading. We are living in a brave, new, and peculiar world. So be safe out there. And thanks to all of you for joining the Express Live every Monday at 10 o'clock and on demand on your favorite podcast networks. Shout out to our good friend Kenny Polcari for joining the show. You got to tune in to Kenny. He is one of the smartest, most entertaining people in our industry. I love reading and listening to his analysis, plus those recipes. Cyberscript Profiler, thank you for joining the show. Thanks to all of you. He's on YouTube as well. That's right. Strategy Sessions. He's on YouTube as well. Find Kenny Polcari there every day. Maud Baldwin, phenomenal. You are phenomenal, my friend. You have a great week. Romania is in the house. Shout out to you in Romania. Love to have you here. I hope for 2 months of green. Hey, I hope for 12 months of green, Savage God. Let's go. Let's keep doing this. Yes, stocks are overvalued and some are still overvalued. Absolutely. And that's the beauty of investing. You got to find those pockets of places where you think value can rise higher. Top Flow, peace out to you, my friend. Thanks to all of our listeners and viewers from around the world. We love having you join the Investopedia Express. We love your comments, and you just keep them coming because you are the smartest investors in the world. We will talk again a little further on down the line.